So now we're going to talk about trading option spreads, and we have two types of option spread trades. We use option debit spreads, and we use the profit guard market neutral spreads. So with these two types of spreads, you can't get into trouble because you're only risking the cost of the spread if the market goes against you. And these spreads can profit if the market is up, flat, or even down at option expiration. And I'll show you some examples of that here shortly. And we show examples of our in-the-money debit spreads that we initiated recently, and most of those have a 30 to 40% profit potential, even if the underlying stock declines 10% at option expiration. So even if we have a 10% decline in the stock on most of our spread trades, we can still realize a profit. And there's two ways to enter a spread trade. You can initiate both legs of the spread simultaneously, or you can leg into the spread at a later date. So I'll show you examples of both types. And bullish spreads have a long position and a short position. The long position profits as the underlying stock moves up in price, and the short position profits as the underlying stock moves down in price. So you have a long and short position in these spreads, and that allows us to trade and profit in volatile markets, because if you have a directional trade, you can get stopped out in a volatile market, but with a spread trade, because you have that short position, it allows you to ride out volatile markets in most cases. So when we select the type of spread trade we like to trade, we trade debit spreads on stocks with rich option premiums, and then we trade the profit guard market neutral spreads on stocks with low option premiums. So we trade both in our portfolios, and we like to use the debit spreads on stocks with the richer option premiums, because it makes more sense, because you're short a call option, and if that call option has a lot of premium in it, you're gonna profit. So and then with the profit guard spreads, we're buying a put option to protect our call option purchase. So we usually will trade the profit guard spreads on stocks with low option premiums. So let's look at bullish debit spreads. And I covered the profit guard strategy in my last presentation. So today we're just going to focus on the debit spreads. So with debit spreads, you can profit if the underlying stock is up, flat, or down at option expiration. And you can create a debit spread by buying an in-the-money call option and then sell a related call option with a higher strike price with the same expiration date. So the call purchase and the call sale can be done simultaneously, or you can purchase a call, use the money management guidelines when you purchase the call, and then if you have a profit in that call at a later date, you can sell a call to leg into the spread. So we like to use both methods to enter debit spreads. And the call option that you purchase, of course, profits if the price of the underlying stock increases. The call option that you sold will profit if the price of the stock decreases. So you have a long and a short position with these debit spreads, and your risk is limited to the cost of the spread. And we normally initiate spreads that are 1 to 3 months out until expiration, and most of the spreads cost between $600 and $750. So you can trade a portfolio of these debit spreads in a $5,000 trading account. And again, your risk is limited to the cost of the spread. And as I mentioned, most of the time we can realize a profit if the stock is flat or even down at option expiration. So obviously you're going to have a much higher probability of success as a trader if you can profit when your stock is flat or even down at expiration. So that gives you a big advantage over directional trading. And debit spreads work just as well in down markets. During the 2001 and 2008 bear markets, we profited from bearish debit spreads. So the trend reversed during the bear market, and we started to enter bearish debit spreads, and we're able to profit throughout both of those bear markets with our bearish debit spreads. And the bearish debit spreads use put options. Okay, let's look at first a simultaneous entry into a debit spread. And we'll look at some actual examples that we implemented recently. And these examples expired 1.5 to 2 months out. So let's look at some examples of simultaneous entries. And with the simultaneous entry, you're buying to open a call option, and then you're selling to open a call option simultaneously with a higher strike price. So that's how we enter a simultaneous debit spread. Here's a trade we took recently. This is for the SOXL, the SOXL, and that's the symbol for the leveraged semiconductor ETF. And SOXL was on a prime trade select buy signal. We used the 1% rule to enter the trade and select the strike price. The trade was profitable, and we also used the Keltner channels to enter our trade, and the 50-day, the SOXL 50-day EMA was above the 100-day EMA, so it was on a buy signal, and it retraced near this middle Keltner channel, which set up a buy opportunity for a spread trade. So we used prime trade select to select this trade. It was on a 50-day EMA buy signal, retraced towards the lower channel, and that set up an entry point to initiate the simultaneous trade. So our brokerage confirmation shows that we bought to open the 140 strike calls at 35.90, and we sold to open the 150 strike calls at 29. So this created an option debit spread, and both the buy and the sell were done simultaneously. And at the time, SOXL was trading at 166.72 when we initiated the trade. So we bought the 140 call, sold the 150 call, and they were both in the money. So this was an in the money debit spread because both strike prices were below the current trading price of the ETF. So we bought the 140 call 35.90, sold to open the 150 call at 29. So this spread had a net debit of 6.90. So the cost was $690, and our brokerage account was debited $690 to initiate this spread. So cost was $690, and that's also the maximum risk in this case. So in the money spreads give us more downside protection and a higher probability that the trade will be profitable. And you'll see in these examples that these in the money spreads can even profit if the underlying stock is down as much as 10% at option expiration. So we can still profit even if the stock is down. So we designed a series of 6 calculators to calculate the profit potential for option trades, including debit spreads. So let's take a look at the profit loss potential for this SOXL trade using the debit spread calculator. And the calculator will calculate the profit potential for a trade assuming various price changes in SOXL at option expiration. In this example, from a 10% increase in the stock price to a 10% decrease in the stock price. So these inputs are variable, so you can input whatever you want into here to see the profit potential for a stock. In this example, we're assuming a 10% increase in the stock price in this column and a 10% decrease in the stock price in this column. So it'll calculate the profit potential based on the closing price of the stock at option expiration. And in this example, SOXL was trading at 166.72. We bought the 140 strike call at 35.90, sold the 150 strike call at 29, and we hit calculate, and then it will calculate the profit potential for this trade. The second row from the bottom lists the dollar profit potential, and the bottom row lists the percent return for this trade. So we can see that if SOXL is up at all, or if it's flat at option expiration at 166.72, we'll realize a 44.9% return on this trade. So if the stock is flat or goes up at all, we'll realize a 44% return. And if it's down 10% to 150.05 at option expiration, we'll still realize a 44% return for this trade. So again, if the ETF is up at expiration, 44% return. If it's flat, 44% return. And if it's down 10%, we still get a 44% return. So if you can get a 44% return when your stock is flat or down 10%, that obviously is going to give you a much higher probability of success as a trader.